Hi, this is Ken Boyd with the Accounting Accidentally website. You'll find over 300 blog posts on the site, and if you scroll down just a little bit to the middle, you'll find over 400 YouTube videos. And I wanted to finish up a discussion that I started on the statement of cash flows. This is a spreadsheet that links the cash flow statement with both a balance sheet and an income statement. We had started in the last video talking about the indirect method for the cash flow from operations, and the fact that you reconcile from net income. Here at the top, you'll see for all 4 years. You make adjustments that I covered in the prior video, and you end up with cash flow from operations in brown. What makes this difficult is that an increase in current assets gets subtracted. So let's use accounts receivable in 2002 for an example. If I click on the cell here and I scroll up to accounts receivable, you'll see that the balance increased, but if you scroll down to the cash flow statement, it's subtracted. So current asset balance increases get subtracted for current assets. Current liability increases, on the other hand, get added. So what I covered in the last video is how you get reconciled from net income down to the actual cash flow from operations. And you'll see more on this information in the middle in the first video. So cash flow from operations is the day-to-day activities of your business, which is making a product, selling it to customers, collecting money from clients. Investing is buying assets and selling them. So this happens to be PP&E, property, plant, and equipment, other fixed assets. And then finally, financing is raising money to run your business and paying it back. For example, if you pay a dividend, here that's a decrease in cash flow for financing. So if I click on the net increase or decrease in cash, you'll see it's the sum of operations plus investing plus financing, those ins and outs. And it comes down to $45 in the negative. And what you'll also find as a check figure is that the decrease or increase in cash matches the change in cash in the balance sheet. So if I scroll up, you'll see that cash between 01 and 02 declined by $45, and that's the increase and decrease in cash in the cash flow statement. And that is how actually accountants check to make sure that they've done the cash flow statement correctly. So the best way to learn this is to have an example that combines the income statement and the balance sheet, and the changes in both those statements are linked to the cash flow statement. It's the best way to learn how to do statement of cash flows. As a reminder here, if we finish up, I'm coming out in 2020 with 25 intermediate accounting spreadsheets and how to use them, which solves the problem of learning accounting by combining a written text using snapshots from the spreadsheets. You'll get the spreadsheets themselves, and you'll also get links to the YouTube videos. This happens to be the example for the effective interest rate method. So if you'd like sample chapters of the book, you can email me at ken@stltest.net, and I'll send them to you, an example each month. And then when the book comes out next year, I'll let you know about that too. And I hope that ends the frustration of studying intermediate accounting. Thanks very much for watching, and we'll see you next time.